Welcome back to Global Currency Watch. If you are looking for grounded, research-backed economic breakdowns without the hype, make sure to hit that subscribe button right now. If you have been following the Iraqi, Dinar, or central bank shifts across the Middle East, there is one question that dominates every conversation. When is the exchange rate going to change? I completely understand that question. It is on every holder's mind. But underneath that endless debate, there is another question that almost nobody is talking about. A question that could completely change your perspective. What if Iraq does not revalue the dinar currently sitting in circulation? What if they decide to reprint or redenominate the currency entirely? Stay with me for the next few minutes. Today, we are looking at the real numbers. We will break down the exact math of a currency reprint, why the Central Bank of Iraq might consider it, historical precedents like Zimbabwe, and why the sudden rise of digital banking changes everything. Let us start with the most fundamental question. What does it actually cost a central bank to print and deploy a brand new physical currency? Modern high-security banknotes with watermarks and embedded security threads cost between 10 cents and 20 cents per note to produce. Financial analysts estimate that Iraq currently has somewhere between 4 billion and 8 billion physical banknotes in circulation. That includes cash in banks, cash stashed in homes, and physical notes held by international investors around the world. Let us run the numbers. If Iraq reprints 4 billion notes at 10 cents each, that is $400 million in printing costs alone. If they reprint 6 billion notes at 15 cents per note, that number climbs to $900 million. And at the high estimate of 8 billion notes, you are looking at over $1.2 billion just for the printing process. When you add shipping, insurance, vault security, and recalibrating every ATM across the country, a complete currency replacement would cost Iraq between $800 million and $1.5 billion. Now, can Iraq afford that? Absolutely. Iraq holds over $90 billion in foreign exchange reserves. A $1.5 billion operation represents only about 1% of their total reserves. Financially, the Central Bank of Iraq could afford a reprint. But why would they want to do it in the first place? To understand why a central bank would replace its physical currency, you have to look at their biggest challenge: loss of monetary control. Right now, the Central Bank of Iraq faces a massive structural issue. An overwhelming percentage of Iraqi dinars exist completely outside the formal banking system. Because of past economic instability, many citizens prefer keeping physical cash at home in private safes rather than depositing it in bank accounts. Because of this, the central bank cannot easily manage inflation or track the total money supply. A physical currency reprint with a strict exchange window would force every hidden note back into the official banking system to be swapped for new money. Anything not turned in would become worthless. In one single move, the central bank would regain full control over its currency. The institutional motivation is very real. When analyzing currency swaps, economists often look at historical examples like Zimbabwe. When Zimbabwe replaced its hyperinflated currency, they established a strict exchange window. Citizens had a limited number of days to bring their old notes to official banks. Once that window closed, the old notes expired permanently. For people living inside the country, it was a fast transition. But for foreign investors holding physical notes outside the country, short exchange windows create serious logistical challenges, including international banking regulations and cross-border compliance checks. This is why informed holders pay close attention to central bank updates and official banking channels, ensuring they stay prepared for any major policy announcements. Now, here is the most important part of this analysis and why a physical reprint scenario is far less likely today than it was 5 years ago. 5 years ago, a physical reprint was the main way for a central bank to regain monetary control. But central banking tools have evolved. Today, central banks are prioritizing digital banking infrastructure, electronic payment systems, and digital currency frameworks. Think about this. If the Central Bank of Iraq can achieve monetary control through digital banking integration, why would they spend $1.5 billion on printing and shipping billions of physical paper notes? Digital banking gives the central bank real-time tracking, eliminates massive printing costs, and connects local businesses directly to formal electronic financial systems. As electronic payments and mobile wallets expand across Iraq, the necessity for an expensive physical currency reprint drops significantly. Let us bring this all together. Could Iraq physically reprint its currency? Yes. The math shows they have the foreign reserves to afford it, and the motive to regain control is clear. Is it the most likely path forward today? Not necessarily. The global transition toward digital banking provides a cleaner, faster, and much cheaper route to achieve financial stability. Your goal as an investor is to look past short-term rumors and focus on actual economic data and central bank developments. If you found this breakdown helpful, hit the like button, subscribe to Global Currency Watch, and drop your thoughts in the comments below. Thank you for watching Global Currency Watch. Stay calm, stay prepared, and I will see you in the next analysis.